joining us on the show is Shweta Rajani, Head of Mutual Funds at Anand Rathi Wealth. Good morning to you, madam, and a very warm welcome. A view that you would hold on quarterly earnings that are coming, anything that catches the fancy of your research team, where quarterly earnings may have increased sequentially, providing a strong entry platform to new shareholders?
Absolutely. So yes, the result season is on, and if I just look at the broader indices first in terms of Nifty 50, there most of the companies I would say have declared their result. Almost 25 on 50 companies have declared their result, and the earnings so far has been in line with the expectations. So this year, practically, we were expecting large caps to be on the muted side. So we are seeing the larger caps giving around a 6% YOY growth for the fourth quarter. If I'm talking about the broader mid and the small cap indices, here in fact we've seen a good amount of profit growth coming in, though only 30% of the universe in this segment has declared its result. But if you actually see, they are showing upwards of 30-40% of profit growth number. So one key takeaway definitely is for us that the broader market is doing better than those typically larger cap names. And second, if we see, a further maybe a sectoral breakdown. Now, in this, what happens is, the banking and financial services account for 1/3 of your Nifty 50 universe, and there we are seeing a decent amount of growth coming in the profits. So, and that's likely to sustain over the next few quarters as well. So, from that standpoint, I think entering into the FY 26-27 number, we could see a rebound in those earnings and from a FY 27 perspective now, for the larger caps, expecting a 12 to 13% profit growth for this FY, given that you would see banking and financial services becoming key contributors, would be a decent expectation to have. And mid and small caps, like I said, having a 4 to 5% growth over and above large cap looks a reasonable expectation.
Okay. Shweta, this is a different kind of a question. Anand Rathi Wealth is generally in the business of providing a deep research into mutual funds. But how come your company is tracking individual equities? What would possibly be the reason for them?
So, we are into the business of wealth management. And when you say wealth management, you're basically helping your clients achieve what their financial objectives would be and helping them in their entire wealth strategy. Mutual funds are a part of it and definitely a key component of that strategy where they invest. And as far as mutual funds are also concerned, mutual funds are market linked. You may rely on a professional fund manager to deliver those kind of returns, to deliver and take those sector and stock calls for you. But ultimately, if you are having a holistic view and you are in a very objective driven approach towards money management, then for me also I break it up into what could the market deliver and what can I expect from the fund manager to deliver basis his or her sector and stock selection. So therefore, it becomes that much more important that you understand the components of market, and you see which segment of the market, which market cap can do well, what is the right market cap mix that the client should have in the portfolio, and within that, you leave the sector and stock decisions to the fund managers. Second, what happens is if you have an overview of what sector is performing how, then that view and to what the fund manager is doing, you can actually link that and try and understand how the mutual fund portfolio is getting constructed and what you can expect from the underlying mutual fund portfolio. So therefore, having a good macro view, having a good understanding of how the profits are moving, how the broader economy is moving, that much for me it becomes the basic research that one must do.
Okay. I was under the impression that for the 13-14 funds that you advise on for long-term wealth creation for your existing and potential clients, you would be analyzing their fund portfolios individual stocks as well, and then probably getting a sense where this fund could be headed depending upon earnings growth or the lack of it. Is that an approach as well?
Absolutely. So that is, so what happens is, one is, let's say, the numbers show that the Nifty 50 earnings could grow at around 12 to 13% range. And if I am expecting the fund manager to outperform Nifty 50, then the earnings growth of the fund's portfolio should be significantly higher than that of the market. And it should be reasonably priced. That's when that earnings growth would also translate into price growth and give me the excess return that I would be expecting a fund manager to deliver. So step one is, understanding the earnings of the broader indices. Next is understanding the earnings of the underlying funds. So if the underlying fund portfolio today is showing an earnings growth potential of 20%, give or take, I'll put some discounting to this number on analyst projections. It gives you an idea of if you are targeting a 3 to 4% more from the mutual fund as an excess return, but you're sitting at a gap of, let's say, 8% on the earnings growth. It therefore increases the probability of the fund giving you an outperformance, assuming that the fund manager would also be far more agile and keep looking at if there is a earnings drop happening in any company or any sector needing any revision or rebalancing in the portfolio, they would undergo that. So what the fund manager's skills are, what is right now the gap between the earnings growth of the fund and the index, gives us some sense of what the future of the fund probably could be.
Okay, fair point. So that's the broader structure, ladies and gentlemen. Is there, ma'am, a catchment of maybe NSE 200, NSE 500 earnings that you track, or is it the entire corporate India? How does the research team narrow down on the stocks that it has to track?
So, see, roughly we would be covering the top 500 companies, but it's just that from a mutual fund standpoint, it gets broken up because you'll have your Nifty 50, which is the broader market index, which everybody tracks and understands. You'll have Nifty 100, you'll have Midcap 150, and you'll have Smallcap 250. So we'll cover 500, which is where almost 70-75% of the fund universe would also be investing. And you break it up into segments, and that gives you a sense of which segment is likely to do better. So right now, if I'm seeing the earnings growth of mid caps so far has been better than small caps and large caps. If I score them, then mid caps, small caps, large caps. This is how the earnings growth has been, and this tells me valuations are reasonable. So earnings is one part. Second is from a valuation standpoint, all the three segments right now, I would say, are in a fair value zone, with in fact small caps being a little at a discount to the fair value. So it tells me some allocation to mid and small caps may make sense in a portfolio. So that helps you create the right balance between what the large, mid, small allocation should be.
Okay, fair point. Now, let's come to the meat of the matter. Any new additions that you have in your existing funds that you are now recommending to clients? How many are they, and what are they in the flexicap and the large cap space?
Yeah. So, right now we've not made any change to what we've been recommending because, in my experience and how we've seen funds also go through cyclicality. So there have been so many instances where you would have seen the worst performing fund in the last 6 months turns out to be the best performing in the next 6 months. This happened with around 2.5 years back with Kotak Emerging. When the fund manager was moving out, we saw the fund dropping to the fourth quartile. But the moment the new fund manager took over the scheme, within the 6 month period, it had turned from bottom to the top quartile. It happened with the top schemes. HDFC Flexi went through a down cycle, and then when value as a style picked up in 21, it again moved from the last ranked to the top ranked. So we don't keep changing funds frequently, and I suggest investors should not get carried away with the recent underperformance, have a review frequency of maybe 12 to 18 months, during which you review your portfolio and see if there's any corrective measure required. Coming to the second part of the question that you asked in terms of what are we recommending right now, in the large and the flexi cap space, we would have a large cap, an HDFC flexi cap, but we actually build the large cap portfolio not through a pure large cap category only, but to categories like large, flexi, dividend yield, large and mid, which have a significant large cap exposure to the portfolio.
So would you share the names of these funds in the categories that you just mentioned?
Sure. So, something like an ICICI dividend yield is what we have in the dividend yield category. In the large and mid cap category, we'd have Bandhan large and mid, and SBI large and mid, DSP large and mid. So, you look at how the underlying portfolio is, the fund manager style. So, you get a blend of different fund management styles. HDFC Flexi would be more value oriented. Then ICICI dividend yield is a dividend yield strategy. You would have the large and mid cap funds, which are either growth oriented or growth at reasonable price. So you create a balance of different fund manager styles also when you are constructing the portfolio.
Okay. In terms of value picks, maybe two funds that you would advise.
So, funds that would have some amount of value or a contra in their portfolio, HDFC Flexi is one, and the other one is also SBI Contra. That, has a different style.
Yes, absolutely. SBI Contra actually celebrated its 26th birthday just a couple of months ago. And we had the pleasure of hosting the fund manager. So that's a wonderful fund and a very wise choice indeed. In terms of small and mid cap holdings, what are the funds that are on the radar of Anand Rathi Wealth?
Sure. So in the small cap space, see here again, you have an HDFC small cap and an Invesco small cap. Those are two. In the mid cap space, you can also go in for a Kotak mid cap. HDFC mid cap is also good, but given that it's the same fund manager, Chirag, managing both mid and small, one can make a choice of which one to go for between the two of them. Both will have a similar style of investing.
Okay. What's the threshold for a fund to enter the Anand Rathi universe of recommendation? Is it simply an annual performance or a certain period of time that the fund necessarily has to exist? Maybe look at two bull and bear markets. How do you narrow down a fund?
Yeah. So clearly I would not prefer going in for an NFO. I would want, the fund to have some track record, and everybody should, wait out for a fund to show some kind of a behavior. So at Anand Rathi, we look at a 3-year track record of funds. So the fund should have been in existence for a 3-year period, during which you can actually see how the portfolio is being constructed. Probably there's half or one cycle that the fund would have experienced. The agility of the fund manager, the stability of the fund management team can be evaluated during this period. And honestly, I don't see the NFOs offering something very different that may not be there in the existing space of the 1,000 odd funds that you have in the open-ended equity category. So NFOs can be avoided, and look at some track record, and then of course you look at various risk return measures, earnings, the fund management style, whether the fund managers created value for clients or no. Look at those various factors before which at least we shortlist or screen funds.
Okay, fair point. Now, was there an international favorite as far as Anand Rathi Wealth is concerned? We've obviously the funds that you've mentioned have over a long period of time created immense wealth, but we all know that Indian markets have gone nowhere in the last 2 years or so. Ditto for funds. Uh, but it's the international space that's done phenomenally well. Nippon AMC's Taiwan fund has done fabulously well. The Nasdaq focused funds from Motilal, as well as Mirei, lots of funds focusing on the US markets have delivered phenomenal returns. Are there any favorites that Anand Rathi Wealth has in the global space minus India?
Sure. So we've been, helping client create their India equity portfolio, and that's where the focus of a year has been towards Indian equity or domestic-oriented mutual funds. And if I look at the long-term track record, actually in dollar terms, India as a market would have if you look at rolling averages of 3 year, 5 year, leaving aside maybe a 15 to 19 period when there was an IT boom, Indian markets would have outperformed a lot of your global peers, including the US equity. Of course, if I look at the most recent period, India has not gone anywhere, and then you've had these foreign markets doing well. But if I am looking at a futuristic view as well, we're talking about India growing at a 10 and a half nominal growth, which ideally would translate into, the equity market returns as well. And you're talking about China or the world average being at that number of 3.5 to 4.5% range. So from that standpoint, also very high probability that you could see Indian equities, if you have a longer term holding period, outperforming the a lot of your offshore jurisdictions or geographies. Having said that, yeah, you're right. If I break down, just apply simple filters on having a decent size of 500 crores, funds which may be on return and Sharpe ratio, risk-adjusted return basis, which have done well. The names, like you mentioned, the Mirai Nasdaq fund, the Motilal fund, you have the Kotak US equities fund. These are some of them which have, which have delivered a decent output. So yeah, those can be considered if you are looking at building a foreign portfolio, or you have, your children who would want to go abroad for studies, and therefore you want to create an offshore fund.
As Anand Rathi Wealth, you don't advise any of these funds to be a part of the long-term wealth creation strategy.
That's right. Yes.
Why would that be?
So like I said, if I am looking at the long-term historical data over there, and just a simple annual average of the last 5, 6 years post-COVID, if I see, including the last year, which has not been so good for the Indian market, and if I break it down, taking into account the currency impact also, you would have, the Indian small caps, Indian mid caps doing better than your S&P 500, and then you'll have Nifty 50. In between, you may have, one or two other geographies which may have done better. So if I am only comparing a Nifty 50 to an S&P 500, then yes, you can say that S&P 500's done better. But the 1 year rolling average of the last 5 years shows that if you've done a mixed basket of large, mid, small in the portfolio, in an actively managed Indian fund would have beaten some of these other indices and stayed invested there for a 5 year period. And when we are talking equities, we are talking long term. So, there's historical data where it shows that being in the Indian market, an investor would not have missed out anything. And in fact, the returns could have been slightly better in dollar terms. If I am also talking about what just IMF forecast or World Bank forecast are on the economic growth, India is likely to be among the fastest growing economies. And IMF forecast is 10.5% nominal GDP for the next 3, 4 years for India. And world average is at 3.5. So you see that differential. And in general, there's a very strong correlation between how the nominal growth moves and how the equity markets behave over 5, 7, 10 year holding periods. So if this has to get translated, it means that Indian equities could outperform some of these other global markets. If that's the view, and valuations right now, if I look at it, we are we are in a fair value zone. Last 1.5 years, you've not moved anywhere. So there's a strong chance of the mean reversion playing out and the valuation rebound taking place. All that would mean that entering into Indian equities today, if if you're looking at today's allocation, would be a good place to be rather than the global exposure. So that's where our view is to have 100% domestic India portfolio. And unless you have a specific need where you need dollar over the next 1 2 years, and therefore you want to create that portfolio. But from a long-term wealth creation standpoint, I'd be as a house, we'd be far more bullish on Indian equities.
A fair point. I mean, this is a discussion that can go on forever, uh, simply because over the last 10 years, the value of the rupee versus the dollar has depreciated so much, and those were extra returns that came in for funds like Motilal Oswal, Nasdaq 100, to some extent even Mafang as well. But we'll leave it for some other time. Shweta, again, thank you so much. It's such a pleasure speaking to you, and I'm sure many of your clients are really happy. I was at your office the other day, and the gentleman that we often speak to, Mr. Aziz, mentioned that March has been a month in which Anand Rathi has made all its customers buy the maximum amount of funds since their existence, somewhere like 800, 900 crores. I'm sure all of them are very happy.
Absolutely, they are, and it's a pleasure being on this show as well. But just to give you also a heads up, when we've looked at markets have obviously moved, and the flows have continued. The rough number suggests that mutual funds may still have got around 36,000 crores in April as well, while we'll have the official numbers coming in. So it's good to see that investors are not getting too panicky about the situation and using this as an opportunity, which they should. So that's such a phenomenal thing to see how the investor behavior and maturity is coming in.
Absolutely.
But great, thank you.
In March, the net FI selling was 1,22,000 crores, and in April, that amount is somewhere to the vicinity of 75,000 crores, and yet the Nifty is around 24,000. It's a full salute to how small cap, mid cap, large cap mutual fund investors have kept our market afloat, and that's the maturity that we are looking forward to improving over the months ahead. Thank you for your time, Shweta.
Thank you so much.